Hello, fellow investors, and welcome back to Borex Investing. So, today's video is going to be about Nebius and the current AI environment. So, the market is tanking and the bears are coming out and claiming a victory. But we've had tons of bullish news around Nebius during the last week. The last earnings report gave us monster ARR guidance, the meta deal, and insane growth numbers. And the investor community was very excited to see those numbers. But since the market took a hit, high beta names like Nebius took a bigger hit than the overall indexes. So today I wanted to zoom out and walk through every major risk and criticism that Nebius faces. I'm going to break them down one by one and give you my view after analyzing these risks. This includes criticisms around profitability, dilution, Capex, depreciation, all that fun stuff. For me, it's still clear that Nebius is an incredible opportunity. But we can't just focus on the good, we also have to look at the challenges too. So let's get into it. So, first, I wanted to talk Oracle, not because Oracle and Nebius are similar, but because Oracle shows us what not to do in the AI infrastructure era. So, similar to Nebius, Oracle had a huge run up in 2025 due to news on them working with OpenAI and building data centers in the US. But this week, an analyst from DA Davidson, yes, by the way, the same firm that just gave Nebius a bullish price target, went on CNBC and called Oracle and CoreWeave examples of bad behavior in the AI buildout. Why did he do that? Well, it's because both companies borrowed aggressively to serve startups with unproven demand. And Oracle specifically inflated backlog numbers tied almost entirely to OpenAI, which later turned out to be flexible commitments OpenAI had no obligation to use. For Oracle, that led to margin compression, credibility issues, and ultimately a massive re rating of the stock. And since then, Oracle is not looking too hot. Or we've also leaned aggressively on debt financing to accelerate expansion, which added significant leverage and exposed them to the same execution and repayment risks we saw highlighted with Oracle. So the case of Oracle and CoreWeave are exposing this heavy debt load to fund the AI buildout. Bank of America confirmed that companies borrowed 75 billion in the last couple of months for spending on AI data centers, so it is a legitimate risk. So why does this matter for Nebius? Because it shows the risk of subpar execution and poor capital discipline. Nebius cannot afford to make these mistakes. But so far, Nebius has done the opposite. Their major deals are with Microsoft and Meta, not speculative startups. Their demand is contracted, booked, and sold out, not vague commitments. Their backlog is tied to real infrastructure that's already being paid for. Chief Revenue Officer Mark Boroditsky pointed out on their latest earnings call that half of their 2026 7 to 9 billion ARR target is already booked. So Oracle really isn't a warning for Nebius, but it's more of a reminder of what can go wrong. Unfortunately, these debt fears are sector-wide and putting pressure on all data center stocks, but again, this is temporary. Eventually, those executing well will be rewarded for their actions, and it's my opinion that Nebius will be on the winning end here. So the over dependency on debt is more of a sector risk, but now let's move on to Nebius specific risks. Risk number one, massive capex and negative cash flow. We should all know by now that Nebius is pre-profit, and it will stay pre-profit for at least the next year. The business model requires land, grid connections, transformers, substation upgrades, data center shells, GPUs, cooling, networking, software layers, staff. It's a massive undertaking. This is tens of billions of dollars over the next several years. Nebius will be cash flow negative for a long time. Nebius will raise capital, issue shares, and will have to take on some debt. Nebius will also dilute shareholders. This isn't a SaaS company that can scale overnight. This is industrial scale AI infrastructure. And this is the part that's scaring some investors right now. And that's why the stock is volatile. This is why the sector is in pain and big tech companies tied to AI are in the red. But remember, this is exactly how the greatest companies in history were built. Amazon diluted shareholders for over a decade to build AWS. Tesla diluted shareholders every year from 2010 to 2020 to build gigafactories. The companies that win megatrends almost always dilute during the build out phase. We'll discuss dilution later in the video, but we need to get people used to it. Experienced investors and people that have been investing in big tech for the last 10, 15 years know this, but newcomers may not. And when we look at Nebius's latest earnings report, it's clear they're ramping Capex sharply going into 2026. This isn't optional. It's the reality of the infrastructure business. Companies that win this AI build out are the ones that will deploy capital early, secure power, build data centers, and scale capacity ahead of demand. Yes, it's going to cost billions. Yes, it creates short term pressure on the balance sheet, but this is exactly how you position yourself for a multi year contracted revenue in a once in a generation technology cycle. Please be aware that eventually, as more capacity comes online, cash flow will turn positive and profits will materialize. But investors need to understand that elevated expenses will always be part of the business model. Even after the data centers are built, chips will need to be purchased. They'll need to be upgraded, and sometimes they'll even need to be replaced. That's simply the nature of high performance AI computing. This is a long term build, but Nebius has everything in place to turn today's Capex pressure into tomorrow's multi-billion-dollar recurring revenue engine. Next risk. So while it seems others focus on financials and Capex challenges, I think that can be figured out with an excellent experienced management team. When it comes to these neo clouds and the building of these data centers, for me, the biggest risk is actually execution risk. It's not dilution. It's not even the AI bubble. It's not revenue timing. It's execution. If Nebius can't physically build enough data centers fast enough with enough power and enough GPUs at a cost efficient level, then the ARR guidance does not even matter. This is a massive coordination effort. It's an enormous multi year project that will cost billions. And this is exactly why the management team matters so much. Nebius isn't run by inexperienced founders. It's led by operators who have already built world-class infrastructure at scale during their time at Yandex. And on top of that, they also have proven leadership across their subsidiaries like ClickHouse and Avride, giving Nebius additional execution depth that most neo-cloud players simply don't have. But still, execution risk is real and it's huge. The good news is that so far everything has been ahead of schedule. 2.5 gigawatts contracted power by 2026, nearly 1 gigawatt of connected power by the end of 2026, and 7 to 9 billion in ARR with 50% already booked. This is all great news. So far, so good, but the rest will still depend on flawless execution. Next risk. Depreciation and hardware decay. I'm seeing a lot of people complain about the realities of data centers, but we really need to talk about this. GPUs die, chips degrade, and hardware wears out. You might remember Sam Altman said GPUs were melting during early ChatGPT intensive loads, I think when people were generating all those Simpson styles images. So this is not a buy one GPU farm and print money forever business. It's ongoing. Replacements, upgrades, cooling improvements, networking upgrades, maintenance, full refresh cycles every 4 or 5 years. The team will have to reinvest future cash flows back into the business. But the advantage is that they're not just building metal boxes and renting GPU space. They're building a full stack AI platform that goes far beyond physical infrastructure. You have Aether Cloud, distributed training systems, high efficiency inference pipelines, vertical specific optimizations, the token factory, edge delivery, and multi-cloud orchestration. This almost positions Nebius as a hybrid of AWS plus NVIDIA plus Databricks in a single stack, which gives them more control over value capture. It also gives them higher long-term margins and far more pricing power than a basic compute rental provider. And really because depreciation is such a major factor in this industry, with GPUs aging, hardware cycle shortening, and data centers requiring constant refresh, the entire space should eventually shift towards emphasizing EBIT and true operating profitability. But when you factor in the full stack model and the software layers that Nebius is building, they're really one of the few companies structurally positioned to show strong EBIT expansion over time, even in a depreciation heavy environment. Okay, next risk. This is a big one currently on X. People complaining about dilution. I get it. Dilution is not fun. Nobody loves it when shares of companies they own are diluted. But like I said earlier, dilution is how Amazon funded AWS, Tesla funded gigafactories, Nvidia funded CUDA transitions and fabs, CrowdStrike funded global scaling, Snowflake funded worldwide data centers, and Meta funded Reality Labs and global DCs. Dilution is only bad if the company fails to create value with the capital it raises. But if that dilution funds capacity that increases future revenues, 5x, long-term investors will still win. Nebius issuing up to 25 million shares, which is around 10% of the total float, is completely normal for a company scaling into a global AI infrastructure cycle. This is how every single major tech winner funded its early growth. They all relied on sustained dilution to build the foundation for multi-decade compounding. So what matters isn't the dilution itself, but the return on the dilution. How efficiently Nebius turns new capital into power secured, GPUs deployed, data centers built, and ARR contracted. As long as execution remains strong and ROIC trends upward, dilution becomes a strategic tool rather than a shareholder threat, which is why I view this as a necessity, a manageable risk, and not a fatal flaw. All right, the next risk. The loudest risk is obviously pertaining to this talk of an AI bubble. A ton of bears are celebrating this week, and I'm sure they made a killing on their puts. But there's some saying that, oh, the AI trade is dead. Let's relax with that talk. The most famous bear, Michael Burry, who shorted AI, has been all over the news, and this is where this story gets interesting. So let's remember Michael Burry shorted both Palantir and Nvidia. We found out this week that these were very tiny relative to his total portfolio. They were only worth about 9 million and not the nearly 1 billion that CNBC reported. And now we're hearing that his firm, Scion Capital, has been dissolved entirely, as confirmed by his latest tweets. Apparently, Michael Burry will now focus on being a content creator. Seriously, I think that's awesome. But going back to the AI bubble talk, let's step back and look at the actual facts in front of us. Nvidia's demand is accelerating. AMD is seeing huge sales growth and demand. Meta is heavily increasing its AI engineering spending. Microsoft still cannot secure enough GPUs. AI inference costs are rising exponentially. Morgan Stanley expects US AI power demand to rise nearly 20% by 2028, and GPU capacity remains sold out across every major provider. All of this flows directly into higher revenue for the winners in the AI race. This is a global build out of physical high performance infrastructure. Every country, every enterprise, every hyperscaler is racing to expand compute, power, and data center capacity. And just like we had in the dot-com era, a wave of new companies has rushed into the space. But most of those new companies will not survive. The firms without revenue, without pricing power, and without defensible margins will naturally get filtered out during the market pullbacks. That's exactly what happened in 2000. The majority disappeared, but the companies with real traction, your Amazons, Googles, Apples, Netflix, they became generational winners when the dust settled. And I think we're seeing the same pattern now with AI. Yes, it feels bubbly at times. Yes, valuations in places look stretched. But for companies like Nvidia, Microsoft, Tesla, Google, Amazon, AMD, Palantir, and potentially Nebius, the story is different. They have real demand, real revenue visibility, and they provide the core infrastructure that the AI revolution cannot happen without. Will the ride be smooth? Of course not. Nothing transformative ever is smooth, but the runway in front of this industry is still massive and the long term trend is unmistakable. Now, I want to address the other side, the bulls, specifically the emotional bulls. I've seen a lot of people on X throwing out insane price targets for Nebius. $300 by 2026, 600 by next year, $1,000 stock incoming. Look, I love the enthusiasm, but that's not realistic right now. You have to be pragmatic here. We've already had a run up this year and it was too hot, and that's why we scaled back. I'm bullish, but I'm not delusional. You have to factor in execution risk, Capex cycles, dilution, depreciation, timeline uncertainty, market cycles, recession risk, rate cut timing. And this is all why Wall Street tops out with their price targets around $200. I'm in the same zone. I updated my long-term price target from 114 to 200 after the Microsoft deal because I figured it would provide around 45 billion of annual revenue over the next 4 to 5 years. I factored in execution risk. Now, looking at the price today, we are significantly under that. So I believe this stock is currently underpriced. And by the way, we did just get a new price target from Goldman Sachs. They are known for being fairly conservative and they just upgraded Nebius to a buy with a $155 price target. Look, could Nebius hit $300 or $600 eventually? Yeah, maybe. It's a possibility, but not this or next year. Let's be realistic here. There is unbelievable upside here, and even a simple double from where we are now would already be an incredible achievement. That's absolutely possible, but let's not get carried away with fantasy price targets for 2026. This story will take real execution, real revenue, and real time. The upside is massive, but it won't come easy. So, yes, Nebius has real risks, bigger than most companies, but they also have reasons to be extremely bullish. So the stock is currently trading at about 3x 2026 ARR. It's worth noting that Nebius reports annualized run rate revenue, which takes the final month of the year and multiplies it by 12. Yes, that inflates the headline number a bit, but even after adjusting for that, the current price is unbelievably cheap for a company growing at this speed and building out this kind of infrastructure. And if you're concerned about current market conditions, remember, this market won't stay bearish forever. Catalysts are coming. Once government data returns, the Supreme Court tariff situation clears up, Nvidia reports a strong Q3, Buffett explains his Google position, and the Fed delivers that December rate cut, sentiment will flip fast, and a Santa rally is absolutely on the table. So yes, Nebius is a calculated risk, but it's one I'm fully willing to take. All right, that's it for now. Let me know what you think of Nebius's risks in the comments. If you enjoyed this, please like and subscribe. Thanks for watching, and I'll see you next time.